The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events. Now, here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. Before we go to our guest, Dave, I think it's worth talking about the two ways that people look at markets. Okay, you've got what people call fundamentalists who are always looking at the news and saying, the analysis of the news would make me do this. Then you have the other side of the market, if we're looking at extremes, the technical analysis, where they really don't care what market they're looking at. They're looking at a chart. It could be soybeans, it could be stocks, it could be gold, but really what they're doing is they're looking for patterns in the chart. And I think sometimes it's important to try to mesh the two and understand the dynamic of what's the sort of a symbiotic relationship between the two.
When we visited with David Gurwitz, I had the opportunity to, on a Fox interview last year, and what was not immediately obvious to me then is his great love for music, mathematics, and things of that nature. And it makes a lot more sense now, his interest in technical analysis and order, there being a structure to things, and there being sort of fundamentals, if you will, embedded in a technical picture. And so our conversation today, looking at super cycles, looking at cycles of all kinds, but understanding that there is, again, a message embedded in the pictures that we look at when we're looking at charts, and determining what we can learn from the past and perhaps even predict into the future what will happen on that basis.
One of the things I loved hearing him say when he was talking about charts and cycles on another program, he said, you know what? We don't believe in randomness. We don't believe these things happen randomly. We believe that God runs the show. And so it goes very deep into his own belief system that cycles do repeat.
Mr. Gurwitz, great to have you with us. Charles Nitter Research is a group that looks at things, I think, in a very unique way through a technical lens, but to limit it to that, I think, would be to ignore some things that are behind the scenes. You would, I suppose, say that there's fundamentals embedded in the picture when you're looking at technicals. Maybe you can give us a little bit of a sense for how you approach technical analysis, cycle studies, and things of that nature.
A great question, David. Thank you very much for having me. I just want to say at the beginning, you and I were on a show together a year and a half ago. I think it was, I forget, Fox or CNN, and I really appreciated what you had to say. So I'm honored to be talking with you because I've become a fan of you and your vision as well. So thank you very much. I appreciate it. I met Charles 12 years ago. I say former athlete. I'm 59. I'm still an athlete. I was trained by a guy named Red Auerbach, who was put the Celtics together. The reason I mention that is I was trained to be a talent scout. And I met Charles, and I saw he was a genius. I didn't know. He told me he was working at Goldman Sachs. He was a doctor. I didn't know exactly what he did. He brought me down. And he turned out to be one of the secret weapons at Goldman Sachs for about 15 years. And no one knew about him because he was reporting to the head of Global Macro. He discovered in medical school the power of cycles, from the Greek word circle, which is, not the 9-year cycle or the 4-year presidential cycle, but multiple cycles, meaning Apple topping every 3 weeks, 10 weeks, 14 weeks, whatever the computer finds in any data series. And when all those top-to-tops in any stock, bond, commodity, currency, or economic indicator, when you find, in effect, EKGs that are equidistant tops, therefore predictable, and when 17 cycles are topping at the same time, you scratch your head and go, must be a top. Why? We don't know and we don't care. And it turns out that it's incredibly accurate. And he's been doing this 30 years. I met him 15 years ago. We started our business together. We're one of the biggest research firms in the world. We don't manage money and we don't broker, so we just give honest advice about where things are going. And he's made some of the best calls across the stock, bond, commodity, and currency spectrum and economic spectrum, which I look forward to discussing with you. So we think cycles are fundamental. It's a great question you asked. The word fundamental generally is PE, ratios, all stuff that you talk about quite a bit. I've looked at your stuff quite a bit too, but the cycles seem to indicate that the past patterns are going to repeat. And it's something that removes free will, which is difficult for people to accept, but that's in essence what is underlying what the quote-unquote technical work that it is, as you so aptly asked in your question.
So there's many perspectives on cycles. I mean, there's the war cycles, there's, the folks that have written a book maybe in the mid-90s, The Fourth Turning, which sort of looks at a 120-year cycle, which takes on sort of sociological and cultural aspects to it. Really, we're talking about financial issues, but you would say that all of these fit into the same picture.
Correct. I'll even go one step deeper. I have a pretty big bookcase here. I'm staring at a bunch of books, one, The Great Wave, Currency Wars, The Great Super Cycle. People love to find these big things and hope that they're repeating, like the blood red moon that's coming any day now, thinking it's an indication of something. And yes, we find that cycle tops indicate something, cycle bottoms indicate something on a social perspective, because humans get affected. Sunspot cycles have topped, right? And that's something that indicates an effect on human behavior, according to Charles. And if you look at the NASA charts and the sunspot charts and the Dow charts, there's a lot to them that are similar. And people laugh at it, but the reality is it's one of the things we look at. It's not the main thing, obviously. The key is still cycles and target algorithm, which is based on rocket science, actually. It's based on the decay and the trajectory of shooting a bullet out of a gun. So how do we know gold was going to go to 1900 after a 10-year run-up and then call the top and been down for 2 years, and we think the bottom is in a few months, which is the same idea about Apple, which called the top. But there's factors around in physics that are all around that affect us, so why wouldn't they be in markets as well?
Well, so let's dive into a number of the specific markets and sort of get a perspective, things that you would conclude on what you see the long-term trend of the dollar. If you wanted to go back 101 years now since the inception of the Fed, it's been down. And, of course, we had the move higher to about 120. Now we're below 80 on the Euro index, and many have called for a rally from here. The dollar's going higher. Where do you think the dollar's going, and how would you piece that together? Let's start with the dollar and then move to the Treasury market and a couple of other markets.
Great. I'd like to talk about the dollar and maybe some other currencies as well, because we believe that's us too. The dollar, we think, is long-term topping at the end of the second quarter, beginning of third quarter, and down for a long time. So it will continue what you said, this downward move. We think it's going to continue. 4 years ago, when was the first Greek crisis, David? I remember what year, 4 years ago? Something like that, 4 or 5 years ago?
Sure, 2010. It basically peaked in 2011.
Right. So we called the euro at $1.51 3 months before the first Greek crisis and said that was the top and said it was going to 122 per dollar then, which is exactly where it went. So the dollar strengthened during that time, right? And then, of course, the Aussie and the Canadian we called to par when they were 68, and they went to par. So the cycles definitely influence currencies. It's hard to trade currencies because they move so fast. But we think the dollar is majorly topping, which is why one of our long-term Dow predictions, which we'll get to also, is that the next 5 years is down substantially to the end of the decade. And then the decade of the 20s is going to be an unbelievable up move in equities for that decade. It's going to be one of the greatest, if not the greatest, decade of equity moves up after the next 5 years of not so pleasant. And yet, if the dollar will be half the value, then even if the Dow goes to 80,000 from 5,000, crazy numbers in both directions, in effect, it's only the equivalent of 40,000 because the dollar is what it's pegged today. So while it's a large up move dollar-wise, it wouldn't be. People have to think about that as well. So we think the dollar's topping, and we think the question is which of the other currencies will be the better of a bad lot. And we kept everyone from shorting the euro about a year and a half ago, and everyone really looked bad, and it was a very good call. And we think the yen longer term is down, and we think there's going to be a real mess in the world, which is going to be played out largely in the currency.
Then we've got the Treasury market, and this is, I think, it brings in an interesting element because on the one hand, we talk about the removal of free will in the context of these cycle studies, and yet you have the imposition of will, kind of a top-down approach, if you will, from the ECB, from the Fed, from the Bank of Japan, extraordinary measures in the marketplace. And we know that rates are not where they should be. They're lower, considerably lower, below a market rate. And yet I refer back to sort of the days of Alan Shaw and Louise Yamada doing technical work with Solomon Smith Barney, some great stuff a decade ago. And they would say, long-term interest rates, we should be at the end of a cycle at about 32 years, and it should be going up. Well, how do you factor in, the U.S. Treasury market where it is? What's to say in your mind, how would you address this issue? Why not keep rates at zero forever?
Great question. Let's go over the last 200 years rates, because you are a historian, so it's a pleasure to speak to you. 30 years ago, rates were high, beginning of 1980. Let's say you did two trades, 1981, 1982. You bought the Dow, which was 1,000. Now it's 15 times higher. And you bought 30-year T-bill, and the rates were 18%. Now they're near zero. Two great trades. And had you just held them the whole time, it would have been great. If you did that same pair trade in 87, the bond trade would have been great. The stock trade obviously wouldn't have been. Same idea in 2000 and 2007. You've had those knockdowns in stocks, but bonds have pretty much been a great down move all the way. Let's go 60 years ago. And I just spoke to a client who's 82, and he remembers when rates were 2% when he was 22. Right? So he remembers today's rates 60 years ago. That's a complete 60-year cycle. Go back 90 years, he wasn't alive, but rates were high in now it's 2013, let's go 2014, let's go 1980 high, 1950 low, 1920 before World War I, actually right after World War I, rates were high. 1890 they were low, and Civil War they were high. 1830 low, and 1800 they were high. There's a complete 60-year cycle in rates. So we do think they're going up the next 30 years. However, we called the beginning of this year short-term to be long bonds, which we still think now up through the summer. So you're right that it seems like the Fed or the ECB steps in and changes things, but in essence they seem to act in accordance with the cycles, because they wouldn't have had to step in 4 years ago when we were begging people to buy the 10-year at 4%. And they've stepped in now in the last 5-year stock run-up. It seems to be attributed to that. But the reality is cycles indicate when something's going to happen, not just that what happens afterwards. So we still believe that the cycles overpower the free will. The free will seems to come along at that time. You know, Carter was elected as cycle top, and Reagan was elected as cycle bottom. And one of the things Charles likes to say is there was a conscious picking, or maybe a candidate comes along at that time to make it a top or make it a bottom. It's so deep below the surface of what's going on with the cycle analysis. So rates will be down for the next year, we still think. So it seems like that 60-year cycle stretched out, but it doesn't change our point of view that we're going to get a massive increase in rates going forward. So in effect, stocks will be down and bonds will be down over the next 5 years, which is going to make it really interesting for investors, according to us.
Is it fair to say that there's some variance? I mean, let's say it is a 30-year cycle. I mean, is there an allowance, a 5% variance, a 10% variance where, you know, a 30-year cycle could be 27 or it could be 32?
Yes, that's for sure. Yes, I'll give you an example. I just on the phone with Charles in a sovereign wealth fund, and he was saying we have a wedge formation in the Dow, and so it looks like June is the top in stocks, and cycles are topping. Then also we like to line them all up, not just cycles, not just target, but other quote-unquote technicals, wedge formation, MACD, oscillator, Elliott wave. If they're all lining up, we feel very comfortable that everything is telling us something. So, but things get stretched, and they don't always work in accordance with what we think, which is, look, humans come up with a system. By definition, it can't be perfect because we're not perfect. But generally, if we have to look back over 200 years, you know, and I would just say I'm working with them 12 years, it's accurate about 80% of the time. Not always. Nothing is. And so, yes, things do get stretched, and they just do. But overall, they're strong enough and accurate enough that we stick with it until we're proven otherwise. But this is our big picture, stocks-wise, bond-wise. We think it's going to be very, very, rough on people. Gold, we think, is bottoming in the summer. Grains, corn, which we should talk about also. We just called coffee bottom a few months ago, and that's up until January next year. All these things are following cycles. So, people attempt to say that there's some intervention that's doing something, or high-speed trading, or this and that, but we still think it's all built into the overall system that they don't control. But you're right, it does get stretched out sometimes.
So let's talk about gold, because the call at 1900, there was probably reasons for that, and again, maybe not all of your studies line up exactly the same. Maybe the Fibonacci numbers would have had it going into a higher level than 19, but your cycle studies in aggregate said 1900 was the top.
Right.
One question, because, certainly this last trade, I know you expected some resistance at 1,400, and there we are, 1,390, and then backing off of those numbers.
Right.
Some people have said there's a double bottom at 1,180. And, of course, you've got Goldman and Societe Generale saying, no, come on. You're going to 1,000, you're going to 800, you're going considerably lower on the gold price. Could you address that?
Great question. We don't see that, but we definitely see a strong down move before that longer-term tradable low in June. So that target down, really the question you're asking was a great question, is how do you determine targets? And the answer is we need a move in order to see where it's going. We called this move from 13 up to 14, now bounced down. We see a little pop actually now, but we think there's going to be one more knockdown, and I'd love to get back with you then to when that is. I'll even put you on the research. You can actually discuss it and see when we finally get a down target. We'll give it, and then when we get to that target, assuming that the level gets there and the date of the cycle turn, because cycles only give you direction and timing, they don't give you levels. And then that's a great time to plan to buy options going the other way, because we think the gold and silver will retrace to their highs again, which is quite a move. But we don't have that down move yet, although 1180 is not something that's a crazy number. We actually saw that. Look, we show in crude, which we'll talk in a second, we see 122. Nobody else has that number. And we see it starting in summer. Does it mean war? Could be, because we have war cycle, which we'll talk about also bottoming like a year ago. And if you look at the last year, while there hasn't been major war, there's been a lot of stuff lining up that could be, all over the world, actually. And that also follows cycles. It's difficult to follow.
I want to come back to gold and, a tradable low in looking at, a return to the highs, 1900. What we've seen over the last 10 years, the dollar market has shed basically 1/3 of its value. And gold's moved up 250, 300%, not including, that factors in massive correction. It's been a tremendous outperformer relative to equities, relative to a number of other asset classes. The challenge is to imagine gold only being at 1900 if your dollar call is correct. If the dollar over the next 2, 3, 4 years sheds another third or even half, again, it would be difficult for me to conceive of gold at 1900 only.
You're correct. We see it going 25 is the first stop. And then we show a higher number after, but we want to get to that first number and see where we're holding, but we definitely see 2,500. That's a big move, obviously.
No, I understand.
Yeah, but when it was 1900, David, it wasn't such a big move. It had been 10 years up, and everybody figured it was going to go, especially Australia and Western Canada. We have a lot of clients all over the world. Once things go for 10 years, hard to get used to it going the other way. Apple, we called the bottom 199, then we put puts at 702. We still think it's going to go back up starting the summer, opposite the stock market. So what does that mean? Maybe Apple takes over the whole TV industry. I don't know. That's how we look at cycles, say something's going to happen, then we figure out what it is.
So again, there's fundamentals embedded in the picture.
As you correctly said at the beginning, we think it's the most fundamental. Maybe that's why it's so difficult for people to accept, because it's so deep. It means it's not random.
So gold, is sort of the stepsister or little sister, if you will, of the gold market, silver. And then I'd like to transition to industrial commodities, copper, and some of those. But
great.
Silver has been along for the ride. It sort of extended the trend. Spring of 2011, peaked earlier than gold. Now it's been on its back for some time. We went from 4 to 50, back to $18, $19. The gold-silver ratio is 65 to 1, with highs of 100 and lows, if you want to go back to the Hunt Brother days, of, say, 15, which is more in keeping with the end-ground ratio.
Right.
Give us some perspective on silver.
We think it's going to follow gold. A little bit weaker now, longer term actually stronger. But we think it's going to follow in the same pattern as gold. We called the top in silver also. It was 49-something, David. I think it was 50, whatever it was the gold top was.
Yeah, 49 and change.
So that was the same thing, but we think long-term it's going to be a similar pattern to silver. Copper, of course, different animal. We called the top in copper 2 years ago. We had one of our sovereign wealth clients. They don't invest for 2 years. They're 70 billion, 80 billion. They're thinking a long time. They wanted to buy a ton of copper, and we strongly suggested they don't do that, and we were right. And so we just covered copper. By the way, any of your listeners are welcome to write to charlesnether.com and say that we spoke, and they'll get a free month of the research report that comes out 4 times a week.
So generous. Thank you.
Yeah, my pleasure, but that's Charles Nitter Research. So copper, we just wrote in Sunday. Copper cycle still down, have a downside target of around 292, close above 310 needed for it to cancel its sell signal. We called 2 years ago for it was topping, and it fell to a 4-year low. And so if everybody thought, I'm looking back now, February, we said it's under pressure until May. So longer term, copper does not look like it's up. So we think there's still going to be tremendous deflation, which is something also we sent a report last Sunday. Charles and I wrote that I'll send out to all your listeners who write in on deflation. When crude hit 147 on CNBC, Charles said we're going to have deflation. And that had moved up from 19 to 147, took about 6 years. And they thought it was crazy because who thought deflation? And sure enough, crude came down to the high 30s until now it's been in this range, but we still see deflation for the next few years despite all this printing, and then eventually the inflation is really going to kick in. So anyway, that's the story with copper, is that it's been down, it continues to be down.
And certainly the copper price is supportive of that deflationary trend, is slow business cycle, global economy that is not really doing what everyone would like it to do, or what many of the central banks around the world are saying that we are sort of moving towards full-blown recovery.
Right.
Copper tells a different story.
Right.
Then let's look at the equity markets, and crude first and then the equity markets. Crude, you say 122 on the horizon.
Right.
And, that would not be an indication, I guess, of supply and demand. We're swimming in supply. Demand may be more or less strong. But again, the technical picture may have some embedded information in it.
Right.
Of a geopolitical nature, perhaps.
Right, exactly. Let me answer crude and the foreign nat gas, and then we'll go to crude, if that's okay, because there has some connection. And your questions are great, David. It just triggered something that I forgot. Years ago, nat gas was 12, went down to 6. Everybody thought it was going to go back to 12. And we just started covering nat gas at the time. We really never did. And Charles said, I know this may seem crazy, but it's going to $2. And everybody said, how's it going to go $2? Because it's based on cycles, it's going to go to $2. So what happened was a bunch of Canadian banks lent some nat gas producers a lot of money at $6. And then nat gas went to 5, went to 4, went to 350. It's like a house underwater. The bankers sitting around in their office go, you made a loan that was $6, now 350. It's like you made a loan to a house, $500,000. You lent them $400. Now the house is worth $280. You better go do something. So they contacted a bunch of the nat gas producers and said, you better sell. We got to start paying our loan. You're violating the loan covenant. And they started selling. And what happened was the newspaper said nat gas sales caused by bank pressure. And we said, that's not true. Nat gas sales caused by cycles coming down, and then the banks didn't realize it, and they caused the pressure. So nat gas came to 2, and then we've called this run-up, and we think a little bit more to go, and then back down to 2 again. So that's our nat gas picture. Having said that, crude, which I'm going to, again, we sent out a chart this week. I'm just scrolling down now to answer that. But crude oil, we see a nice bull market in crude starting in the summer. And you see this chart going back to 1990. So you have a 25-year chart, even though crude has been around 100-some-odd years. And it's a very clear bottom in July of 2014, up for years. Now, why would that be? I consider you an excellent economist, by the way. I've listened to a lot of your stuff, and you think, which is a pleasure. And obviously you come from a man that obviously is a big thing. I'm a fan of your father also. But you look at the crude, it's up for a couple of years, but if things are going to be bad, why is that? Must be war. And that's not pleasant. And yet that's what it looks like. The bottom's clear in the summer 2014. Now, 5 years ago, if you remember the bull movement in stocks, and I'm kind of pulled a circle together, at the end of the summer 2008, things look great. Charles sent out some, things look great. I don't know what, I just don't like it, get out of the stock market. And everybody was very upset with him. And then the summer of 2008, the fall 2008 was horrible. And beginning of 2009, we went along. Everyone was begging the world that crude would go up, because that would be an indication of economic activity. Now we're worried crude goes up because it's an indication of war. So I think your question is a great question when you say there's fundamentals embedded in the technicals, because depending on what time you are, what year you are, where you are in the cycle, depends on how the world is viewing that particular asset class. And we who try not to put it all together, even though it's hard not to, because cycles show crude, they show nat gas, they show interest rates, they show stocks, they show gold. We don't want to say, well, if that's that, because maybe we're making a wrong interpretation. Of course, it's hard not to do that, but the VIX, for instance, has become a thing people didn't really focus on until the last maybe 7-8 years. We cover that as well in our report. We see crude going up opposite nat gas. Now, there was a lot of fracking that didn't exist 7 years ago. And all of a sudden, that created a lot of, like you say, the world's sloshing in supply. Why would it go up? And you correctly said it's probably geopolitical. And according to cycles, the geopolitical comes along at cycle bottoms and tops. So in effect, according to us, as crazy as it sounds, cycles predict weather. They predict wars. They predict interpretation of events, not what the price is. Because what we think it's supposed to be, like you said, some people think, a rate should be higher, or that we don't know what it should be. We just know what it is based on how humans vote. And since they voted in the past in certain patterns, they're going to repeat like lemmings. That's kind of what we think. And the deeper manifestation of the public events come along at those cycle tops and bottoms.
So there's a variety of things that affect human behavior. Today, we see people very enthusiastic about stocks. Margin levels at all-time highs, $466 billion as a percentage of GDP. For the first time, we're in all of history, we're above 3% of GDP. And, you look at that and you say, okay, well, maybe the Fed can print and the ECB can print and the Bank of Japan can print and even monetize and go directly into the equity market and drive prices higher. From your perspective, you see a top coming in stocks, and as you've said, it's not that you have specific levels in mind, but perhaps direction and timing involved in these cycle studies. Where would we go from here? I mean, would this be a mild 10, 15% correction? It's very common to have 20% corrections. No one likes them, but that's pretty common. Or is this something that's more of a long-term issue?
Great question. I'm going to say we do have level. We think we've seen the top in stocks. It's going to retest it a few times, but we're not going any higher. We have real level. I mean, we picked, sell Apple 702, because
okay.
So and yes, this is down for many years. Big picture, next 5 years, stocks are down. Does it mean it's going to be all the time down? No, there'll be years up 40% during that time. But this is, if you're advising your clients, which I know you are, and I am too, except we're not, investment advisors, we don't manage or broker, so we just say, here's what we see. You go do it depending on your risk tolerance. Go do what you think. But we think this is a major, major top in stocks coming up in June, and that people should hedge or be very concerned about being in stocks. And we also think, while short-term bond rates will stay low for another year or so, we think that's also long-term going to be a problem. I don't know where there's going to be an easy place to hide. Food prices will be a good food, corn, gold, silver, gold stocks, silver stocks, which have obviously been beaten up quite a bit. I spoke up at the Canadian convention for gold companies about 2 months ago. And, you see a lot of beaten up companies the last 2 years. They could have no access to capital, but they know, they hope, they pray that the bottom's coming, and we think it is. Just an idea of peak oil, we have peak gold. And it's a similar concept that they've kind of dug all the easy to get gold, and now it'll be harder to get. So I think stocks, to focus on your question, from what Charles is saying, because it's really what I expressed, have reached the top, that we're going to retest it again. I mean, we're not ready to short yet. We've kept everyone from shorting the last several months. Look, obviously at the end of last year, we called the rally up to the levels, in the S&P in particular, futures, the high 1800s, and we've got a couple of bounces up to retest, but after that, I wouldn't be in stocks. I think we're going to have a long-term correction down. Next year gets very ugly.
It's interesting to me, the conversations that we have with folks that focus really exclusively on the fundamentals and say, well, I don't like pretty pictures, I don't like technicals, but I can tell you when I drill down on a company or on a market what the value is. And, our conversations with Andrew Smithers this last fall, and I meet with him here at the end of the month in Scotland, his view is that we're 70% overvalued in the stock market, looking at Tobin's Q, looking at the cyclically adjusted price earnings multiples, and actually Robert Shiller has gotten on board. They attribute the CAPE to him now, the Shiller PE, Richard Fisher from the Fed just last week in Hong Kong, 2 weeks ago in Hong Kong, was basically saying, yeah, you look at the Shiller PE and stocks are way overpriced, way overvalued. So it's just, I find it interesting. The conversation we're having today, David, is that we come to some similar conclusions, but we may arrive at those conclusions on a different basis. And just like your cycle studies, if there's one cycle study, it may have your attention. But if there's 10 or 15 things pointing to the same conclusion, you better pay attention. 17 cycles overlapping and pointing to one conclusion, you should be sitting up. Is that really what I hear you say?
But that is exactly what our system is. Let me give you some calls Charles has made since I'm working with him for 10 years. He called, and people should go to the site and watch everything he's done is there. Called every CNBC appearance. He said on CNBC, Dow from 10.8 going to 14.5. They went to 14.2, took everyone out. And they said, why are you going out? He said, cycles up top. Why else? So that was a pretty good call. And then he called the Dow, and then in 2008, we took everyone out. We've been long, more or less, out of the last 63 months, been on a buy signal like 52, about 80% of the time. Not always, not everything always right, obviously. At one point, Charles got on TV and actually said he thought the Dow move to 5,000 was beginning then, and then he didn't get back on to say he changed his mind, but he did, and we went long. So we had got out at 14-something the S&P, and we went back in at 13-something, but the press didn't pick that up. So we wrote it back up, but our clients knew, and our clients were still happy. We took them out in December 2008. But you're right, the whole idea is to take data going back a long time so that when it shows up today, it doesn't surprise everyone. I was just reading, one of the people I read is Malden in economics, and he's a very bright guy, and he was bringing somebody else who was saying there seemed to be an iron curtain that came in trading January 3rd. Like all of a sudden, the last year's good news on all these different indicators seemed to change. And we predicted this. We said this in our cycle work that we will be approaching a top mid-December, end December, beginning of January, and that's it. So the perception of things change, which is really, in essence, what you correctly keep asking, is what the cycles show, that there's a perception that is influenced by cycles. As Charles taught me when I met him, it's human interpretation of events is what the cycles show. So if IBM comes out with earnings, at a cycle top, it'll be viewed negatively. At a cycle bottom, it'll be viewed positively. Same news. And you have gotten the four people you mentioned, who I also follow a little bit, very bright. They all say the same thing, but people are afraid. There's no time to go short yet. But we think this June, if you put everything I've been saying together, we summarize top in stock, bottom in corn, bottom in gold, bottom in silver, bottom in crude, top in the dollar, right? And a few other things. It's going to be a very interesting time. Could be, war. Could be some type of blight that comes along indicating, crop failure. Could be weather issues. We don't know. That we can never say what it is. We just see the gives us a look to get a sense of when something's the time to plan one's portfolio. We like to have people plan in advance. We're not so into our daily update, which goes out Monday, Wednesday, Friday, covers 14 different areas, and people can trade every day, every week, every month. We give levels, parameters, buy signal, sell signal. But we'd like to point people 2 months from now, you should be thinking 4 months from now, 2 years from now. I think people like it.
Well, and I think when we consider the next 3 to 5 to 7 years, we're really talking about one of the largest upsets in expectations. Because if anyone is predicating the future on the immediate past, okay, stocks are going higher, bond rates are going to stay low, you're going to see elevated bond prices. There is sort of an extension, if you will, just almost drawing a line on the chart. Whatever direction it's going and trending, we're just going to assume it's going to continue that way. Actually, that was a question that I asked the analyst at Societe Generale when I was in Shanghai a few months ago. And that was basically his conclusion, was if prices are going up, we think they're going to continue to go up. If prices are going down, we think they're going to continue to go down.
David, I'll tell you what's crazy about it. I'll give you a joke. Bob Hope, I don't know if you remember Bob Hope.
Mm-hmm. Yeah.
He was a great investor. He bought a ton of property in L.A. He kept saying, I would just drive to where the houses stopped, and I'd buy the next tract of land, because I just figured at some point they were going to buy. You're talking 30 years ago. He was buying 40 years ago. He became a very rich guy. So that's one way to invest. But if you just keep looking at 200-day moving averages, which is what a lot of people do, the 50-day to 200. What does the 200 represent? It's kind of a year, because how many trading days in a year? 200 and some odd trading days. How could something 10 years ago be factored in? Or even 25 years ago? Well, go through this bond cycle that I mentioned, the 60-year cycle. Go through the stock, go the last 30 years I mentioned, the trade from 1980-81, and the bond trade would have been great, and the stock trade would have been hit 3 times. If you don't consider those in today, look at gold. It had a run up for 10 and a half years, 2 years, we said would only be bounces. If people don't look way back to consider it has an effect today, which I think is part of the problem, you don't have a historical perspective in the world. We have too many machines making us think we're smarter, but we have more information. I don't know if we're smarter. I come from a long line of rabbis. I study Talmud all the time, and the Talmud was written down 2,000 years ago, written down over several hundred years. And the wisdom they had then, they didn't have these machines. They didn't have electricity, but they had wisdom that we don't even touch now. And so we're used to thinking very long term and assuming it has an effect today, whereas what you just said, the analyst thinks if it's going up, it continues. Now, they're going to be blindsided all the time. And look what happened last year. If it was up 30%, why not assume it's going to continue going up 30%? And yet this year we already know is going to be hard and difficult, and it seemed to have hit right away. Who predicted it? Well, we think we did. We said cycles were topping, but that implies multiple cycles, meaning effect of some type of vibrational effect going back years. And people don't seem to factor that in. Take a look at Putin, what he's doing. There's an argument, of course, look at the historical record of Russia. Of course that has some effect to what he's thinking. Now, people don't like to think historically, and yes, crude is very expensive over there to get, and all the different things I'm sure you've written about and spoken about. He's very aware of war cycles. He's not a dumb person, and so the world doesn't seem to want to look back or accept it, and that's one of the issues we have with people who are following short-term perspective. That's why they like that we will think so far back and say it actually is affecting today.
It seems that the next 3 to 5 years represent a tremendous opportunity, as well as a very harrowing time if you're on the wrong side of the trends. And there is this coalescence between fundamental and technical analysis. We find reflecting on psychology, sociology, human behavior, human nature, and a look at history, because that's what we're looking at when we dig up market data. It's not just data. It's a track record of human behavior, the way people have voted, and there's reasons why they've done what they've done at those particular periods in time. That's what we're talking about today, is those things coalescing into a picture and coming to some hard conclusions, but conclusions that have some predictive value. So, David Gurwitz, thank you so much for joining us today, and would encourage our listeners to go to Charles Ninner Research, and if you mention the program, as David has suggested, they'll provide a month's worth of research complimentary. Thank you so much for that offer.
Pleasure, David. I also want to end by saying I'm a big fan of you. Your clients are very lucky to have somebody who is so open-minded to consider a lot of different views and to be thinking that way at such a young age. Because, well, maybe you're not so young, but you seem that way. And I just want to thank you. Like I mentioned at the top of the show, after I saw you, I looked up and watched a lot of your TV and media things, and I was very impressed with your point of view, how you got to things without us, without the cycle work. You got there, and I was really impressed. It's not easy. So I just want to compliment you. I think your listeners are very blessed to have you as an advisor.
Well, listen, I think we would have benefited tremendously had we been reading your research.
Well, now you will.
Exactly, and that has begun. So thank you so much. We'll look forward to all of our future conversations.
Likewise.
Well, you've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany and our guest today, David Gurwitz. You can find us at McAlvany.com. That's McAlvany.com. Give us a call, 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.